Well, good afternoon, ladies and gentlemen, both here in Manchester and online for this seminar about P-FIS. First of all, I'm David Smith from DSW Ventures, and I'm here with Matt Hodgson of National Tax Advisors, Claritas Tax. We're going to talk about pension-funded investment in seed EIS and EIS securities. Before we get into the seminar, just to say for those online, the seminar is being recorded, and we will send a link afterwards both to the recording and to the slides. So there's quite a lot of detail here. If you miss it in the course of the presentation, you'll be able to look through the slides in detail at your own leisure. You can load questions online through the Q&A function on Zoom, and also for the people attending here in presence, if you could ask questions at the end. Okay, so we're going to tell you about how seed EIS and EIS investing can help you extract value from your pension funds without any net tax charge, potentially, and crucially, allow you to bequeath that value in your will very tax efficiently. We gave the idea a snappy acronym P-FIS for ease of reference, but just because we've given it a name doesn't mean it's a product. It's more of a strategy. And it makes full use of the government's own tax incentives and a well-established scheme exactly as they were intended. P-FIS uses early stage investing as the core of the strategy. That brings investment risk. We'll come back to that later in the presentation, but clearly, therefore, P-FIS is not for everybody. Okay, so having skipped that slide, let's make the introductions. I'm a co-founder and a partner in DSW Ventures. We are a seed, EIS, and EIS investing venture capital specialist. I spent 11 years at KPMG, a similar period of time in investment banking, worked at 3i in corporate finance, and managed 3 other funds before co-founding DSW Ventures with Keith Benson. Matt.
Thanks, David. Yeah, so Matt Hodgson, I'm a partner in Claritas Tax, and I also co-own the business and run it. By day, I am an M&A transactional tax advisor, but I also advise on a wide range of taxes. In terms of who we are, we're the UK's largest independent tax advisory and compliance business with over 100 people and 8 offices around the UK.
Thanks, Matt. Before moving on, well, most of you are familiar with CDEIS and EIS. For those who aren't, these are well-established tax incentives intended to drive investment in UK businesses, promoted by the government decades ago. And the incentive is to motivate investors who would otherwise not look at early stage, risky, small investments in software, deep tech, and similar, in return for which they offer very significant tax advantages: immediate tax relief against income tax, capital gains tax relief or deferral, capital gains tax free on any gains, loss relief on any losses, and crucially to this presentation, no inheritance tax payable. In certain circumstances, clearly terms and conditions apply to all of those reliefs. So you have to be careful to get them, and that's one reason why, as we say throughout this, you need to take the right sort of advice. Okay. So let's talk about P-FIS. In the next few slides, I'm going to recap on how tax interacts with pension contributions and drawdowns, and at the time of a legacy following the taxpayer's death. Then look at what's going to change on the 6th of April next year, 2027. And then Matt will take over and outline how P-FIS works and can assist the taxpayer in that journey. Okay, first up, the current position. Income tax already applies to pension drawdowns by the beneficiaries if the original taxpayer has died after the age of 75. So the reward for longevity to us all is that our beneficiaries will pay a load of tax. From the 6th of April 27, in addition, inheritance tax will be charged on the value of the fund bequeathed. That's the key difference, that caused us to put our heads together and start thinking about P-FIS. This is a problem because pension fund legacies have been a mainstay of many taxpayers' planning, and taxpayers have established their position over decades, and unpicking it as a result of government policy changes is very difficult and potentially result in a lot of tax payable. I have a bit of a bugbear about the government doing this. It's a little bit like your student loans. You sign up for a scheme with the government, and then they move the goalposts, and there's not much you can do about it. But in this case, there may be. So P-FIS may be a partial solution to this conundrum. A bunch of boxes. These are probably best studied when we share the slides with you later on, but moving left to right, what we've got here are what happens during your life, paying money into the pension scheme. Red box is cash out, blue box is cash in. Contributions to the pension fund from the taxpayer. In return, often national insurance, not always, under a salary sacrifice scheme, national insurance saved, and income tax saved as well. Pension fund gets paid out with your own contributions and the government's tax savings. Lifetime drawdown. Take the cash out, pay the tax, pay the income tax, not the national insurance. That's hopefully, until rules get changed again, a permanent saving. And then on the right-hand side, you bequeath the fund to your children, your spouse, whoever. So there we show a non-cash transfer, the bequest of the pension fund to the beneficiary. They start drawing it down, and if you're over 75, income tax gets paid on the drawdown. So that's the situation at the moment. What happens in the future? This innocuous little orange box appears. Inheritance tax gets charged on the on the beneficiary's drawdown. That is, I'm going to start again. Tax gets paid at the time of death on the value of the pension scheme. Now that's the change. Just a few details to note at this point. We can't, by the way, possibly cover all situations, all scenarios, all the detail of everybody's individual circumstance. So these are general points, but just a few highlights. This is the case when somebody dies after 75. If somebody was facing, God forbid, but an early demise, this wouldn't be as interesting at all. I'm sure you'd have other things on your mind anyway. We're illustrating the inheritance tax being paid by the taxpayer in these boxes. In practice, the personal representatives will have to pay the IHT out of the estate assets. There is so much detail to be sorted out in the next 12 months, not least of which is making sure there's no double taxation. But quite how this will work, we don't really know yet, but I'm sure the government will make it all clear in the next 12 months. And clearly, inheritance tax doesn't get paid on inheritance tax-free transfers. So if you're going to leave everything to a spouse, maybe a much younger spouse, then this may not be appropriate. So just to highlight a few key issues that may or may not influence whether P-FIS is relevant to your particular circumstance. The scale of the problem is very easily summarized. Inheritance tax will apply at the rate of 40% on the value of the pension fund that is left. The beneficiaries will, as at present, pay income tax at their own marginal rates of up to 45%. So in a worst case position, £100 gets left, 40% is taken on death, leaving £60, and of that, as it gets drawn down over time, another 45% goes. So 33 pence in the pound of your lifetime earnings gets taken as you pass your pension on to your beneficiaries. So at this point, having established how bad things are, Matt's going to tell us how good they can be.
Thanks, David. I'll try and lighten the mood through the next few slides. So I suppose, yeah, my opening comment here would be, who on earth thought we'd be here at this stage 2 years ago? I think, and for the past however long, pensions bequeathed were sacrosanct. You know, people worked their entire lives, saved money as they thought was the right thing to do. But no, obviously, our current government have decided that from April 27, which is not far away, anything bequeathed in a pension, anything undrawn, as they mentioned, will suffer 40% inheritance tax, which has really made people start to think in their lifetime, what can I do with my pension? Particularly those who would probably never have thought of drawing any of it down if they didn't need the money. But this is why this particular idea, which we'll go through, actually makes an awful lot of sense from a tax perspective. So, and just to be clear, we're talking about after the 25% tax-free lump sum in pensions, which you would take anyway. So just moving on to the next slide. That one?
Yes. It's left to.
Yeah. Okay. So, oh, wrong one. Apologies. There we go. Got it. Notes about. Oh, one down.
There we go. Yeah, one down.
Got it. I'll just get used to using a mouse for this. So, the notes about the tax rates.
That's it. That's it.
Oh, no, it keeps moving. So,
do you want to drive it?
yeah, just on to the next slide, which is a note about the tax rates.
Okay.
We're on slide 12. I think that's gone back to 8, hasn't it?
No, what it's done there. Sorry, guys. Apologies, everybody.
There we go, we're moving.
All right.
Just on to 12, on slide 12, really.
There we go. Are you happy with that?
Yeah, it's not quite there, but yeah, it's moving.
There we go.
There we go. Right, I think on this particular slide, we're just talking about the tax rate on the drawdown from the pension initially. So, and what would happen if those monies were reinvested in SEIS investments. So the first thing to note here, and I won't go through verbatim, is that when you do draw down from your pension, tax will be due at the individual's personal marginal rate of tax. That would then be offset by the income tax relief that an individual gets on the way into an SEIS investment, which you can see there will either be 50% for SEIS or 30% for EIS. So it's not going to be a straight offset, but either way, a significant amount of the income tax due on the drawdown will be offset by that investment into the S or EIS qualifying investment. So that's kind of stage one of that tax relief, which is obviously a big saving initially. The other thing is just to draw out on this slide, which is that second bullet regarding CGT. So there are the capital gains tax relief in relation to SEIS, which you can see there halves the CGT rate. You obviously have to have had gains that you then sort of effectively roll into these investments, but you get a 50% exemption from gains reinvested into SEIS investments. But for EIS investments, it's a deferral method. A lot of our clients do choose to do that in terms of rolling gains in. But again, you have to have a gain. So that would be, for instance, where you've sold some other investments, made a gain, but then instead of paying the tax, you roll it into an EIS qualifying investment. I think that those are the key points on that slide. So we can move to the next one. So stage 2, which are the options after drawdown and SEIS investing. So these are the 4 different options that we'll talk through. I think some are much more relevant than others, but it's worth going through each one. I'll be doing A to C, and David will do the slightly easier one, which is effectively spending everything, which is what I advise all my clients to do in their lifetime if they can do. So if we can move to the next slide. Right, so bequesting the SEIS portfolio. So essentially, this is where instead of drawing any monies out, you would effectively draw your monies out of pension, invest it into SEIS qualifying investments in your lifetime, and reinvest those monies as and when the investments realise. So effectively, not taking any gains, not realising any liquid cash, but then on death, basically ensuring that your will bequeaths those investments to whoever it is you choose to leave them to. We can move to the next slide. So in option A, essentially what is happening there, as I mentioned, the taxpayer keeps their portfolio of IHT favoured assets fully invested, and the realisations, as it's saying, go back in. Effectively, that was the left-hand side diagram. Now, the position on the taxpayer's debt is important, and this is the second branch of the tax relief, in addition to the income tax relief on the way in. So the portfolio bequeathed, as you can see there, to the beneficiaries, it's an effective zero IHT relief, because these are still unquoted shares which still qualify. up to, and this was a Keir Starmer U-turn quite recently last year, up to a 2.5 million lifetime allowance. So that is a substantial relief up to that point. Above the 2.5 million lifetime allowance, it then gets restricted to 50%. So half of the 40% inheritance tax becomes due. So that is a important point to note. And then the beneficiaries, as you can see there, can just make periodic cash drawdowns, but we'll come on to talk about the tax treatment of those drawdowns. If we move on to the next one, David. Okay, so as I mentioned at the outset, the taxpayer should keep that portfolio invested throughout their lifetime in what we call IHT favoured assets, which are SEIS invested assets. They could be invested to maintain inheritance tax relief during their lifetime as well. And from 6th of April, I've already mentioned, there is the 2.5 million cap. And then for assets above 2.5 million, they will be taxed at that 20% rate, which I'd already mentioned. Important point at the very bottom there as well is that you actually get a combined spousal allowance of 5 million as well. So that, that's well worth taking advantage of. So, David. So the tax payable by the beneficiaries, which I said I would move on to so it's important to note that the SEIS status, as per the first bullet there, is not passed on to the beneficiaries. So as and when those investments are realised after death, they will be liable to capital gains tax. But it's very, very important to note, and this was something we thought the government changed in the last budget, but thankfully they didn't. There is still what's called a rebasing on death of these types of shares. So essentially, the beneficiary will only pay capital gains tax on the increase from that rebased value on death to when they actually realise the shares. So, hopefully not a huge tax hit at that point. And then similar on income tax, that would only be payable, as it says there, on income arising after death. So, for instance, if you keep that portfolio and it does pay out dividends, which I'm not sure how often that would be, in this case, there would be income tax due on those. So in other words, you can see the estate, so there's no tax other than the reduced inheritance tax, or indeed no inheritance tax if it's beneath the 2.5 million at the date of death. And then on that final bullet there as well. So there is flexibility with valuations on death for inheritance tax purposes. And essentially what we're talking about there is the interaction between the inheritance tax value for the estate and the capital gains tax base cost, which I mentioned at the outset, for beneficiaries, and it's balancing those two effectively. So if it's underneath 2.5 million, we don't care. If it goes above that, then we need to do a bit of a calculation to ensure that not too much IHT is paid, but the CGT is right going forward as well. So next slide, please, David. And then a few final points on option A. The first bullet there, in terms of those SEIS investments, they'll only qualify for inheritance tax relief if they've been held for 2 years before death. That is absolutely important. And obviously, there needs to be the 3-year rule beyond that anyway, in terms of actually it being a qualifying SEIS investment. I suppose interesting language in the sense that elements of jeopardy to the strategy. Essentially what we're saying there is you probably don't want to be making these types of investments if you're 99 or something like that. So it's more about looking ahead and building a portfolio, before death, but not actually realising it. And also you can see there the initial tax reliefs are not clawed back on such an early death as well. So we'll move on to option B. So this is a lifetime gift of the shares. So this is where the investor during their lifetime decides to either in whole or partially start to gift their portfolio to their beneficiaries in their lifetime. So we'll move on to the details of that. So essentially under this option, those gifts can be made potentially one by one, as I said, or in totality. What does that mean? It means the beneficiaries can start to enjoy the cash as the portfolio is realised in their lifetime, on which they will pay capital gains tax because they don't inherit effectively the reliefs. But on the taxpayer's death, because these assets are qualifying for business property relief, the 7-year clock isn't relevant and it's only relevant to the extent it potentially goes beyond that 2.5 million limit. So in an ideal world, to completely hedge your bets, you would gift survive 7 years, but because these forms of shares do qualify for business property relief, it is effectively exempt immediately on gift. Before the gifting, as I mentioned, the taxpayer does need to hold them for that minimum 3-year qualifying period, otherwise they'll lose all of the related tax relief. So obviously, again, it goes back to that strategy of not doing this, immediately before death, and that type of planning wouldn't work. These are directly held shares, and this is more of a effectively an investor point, and they're not fund investments, so it does mean they can be gifted one by one as opposed to having to be an entire portfolio, which can be helpful if you want to make discrete gifts of them to different beneficiaries. And as we mentioned there towards the bottom, those gifted shares would become 100% inheritance tax exempt if the taxpayer survives 7 years after the gift, but noting again that up to 2.5 million completely free anyway of inheritance tax. And then we've lost the slides. They'll be back in a minute.
Are we back?
No.
Sorry.
Okay. I can see them on the screen behind, so I'll carry on. I don't know whether the audience
just
can see
bear
them.
with me for a second. Yeah.
Okay.
Images for this.
Talk amongst yourselves for a minute while we get the slides back on the screen.
Have they come back?
Yeah, they're back. Here we go.
Okay,
Just back in presenter mode, I think. Okay. Yeah, and then we're good. So just continuing in terms of option B and what happens next. So generally, gifts other than to a spouse are liable to CGT for the donor itself, and the gains are exempt once the status is crystallised. So after that 3-year period, they won't trigger a capital gains tax charge. But with bequests, that there could be some flexibility in agreeing valuations of the gifted shares, which I mentioned at the outset in terms of that kind of rebasing on death. But noting there, a low valuation would reduce the CGT-free gain by the taxpayer and create additional capital gains tax for the gift recipient or the beneficiary. And then the final point is a bit of repetition in the sense that if the donor doesn't survive the gift, then once the cash is realised from those shares by the beneficiaries, and there's no latent tax liability, the CGT over market value would become due. So we'll move on from that. And then my final option on C before we move on to David on D is essentially during the investor's lifetime, realising the portfolio and gifting the cash. So essentially, this is probably a scenario where you've got an individual who does need some cash in their lifetime, does want some of the cash, and therefore enjoy the capital gains tax free gains that come out of that. But then during their lifetime, and again back to the 7-year rule, starting to actually gift some of the realised cash to whoever they choose to during their lifetime. So if we move to the detail, David. So essentially, this is the investor on a case-by-case basis realises their investments. They take the gains tax-free, potential loss relief if the SEIS investment isn't successful, and then they can just make a series of cash gifts to their beneficiary out of those realisations, rather than waiting till death, particularly if, say, there's family members who need the cash in their lifetime. So that can be done. I mentioned the 7-year gifting rule. Thankfully, our government didn't change that. I think there was a lot of talk about moving that to 10 years, but that is definitely still 7 years. But importantly, business property relief will not apply those gifts because it's a gift of cash, so it's not a qualifying asset. And then my final slide here is option C, pretty obvious point, but this is definitely a longer term strategy. So realising the investments and gifting the cash, obviously we need that 7-year plus period to ensure that IHT isn't triggered on that gift, but noting that there is a tapering within that 7-year period as well. So it's not 40% straight line for 7 years. It tapers after the first 2 years down to 0 at the end. Why bother? Yeah, good question on this slide. suppose it's the other tax benefits by holding those shares. The actual investor enjoys the CGT relief that they envisaged when they made that investment in the first place, and potential loss relief if and when necessary. The beneficiaries get the cash as opposed to having to wait until death for that. Easier to administer, absolutely, because it doesn't have to go into the estate, doesn't have to go into the will. You don't have to do those wonderful calculations I mentioned that we get involved in probate quite a lot. And then if you don't happen to actually divest of your full portfolio in your lifetime, we're back to option A effectively, where the resultant ones on death will still qualify for business property relief and therefore be fully exempt from inheritance tax.
Thank you, Matt.
Over to you, David.
Of course, to simplify matters, you could just spend the cash, take the cash out of your pension, incur tax, reinvest, get the tax back, wait for the investments to realise, and then just spend the cash. The George best option, as we put it here, go buy yourself another yacht. And the way this doing that a little bit more slowly. So the taxpayer waited as the EIS portfolio realised one by one, took any gains tax-free, enjoyed potentially top loss relief, and then spent the money. And well, the good thing about that is no inheritance tax. Just note, and we said this throughout, we keep on saying as the portfolio is realised, P-FIS as a strategy makes no sense if the investments are turned to dust. So this is all predicated on the fact that the portfolio, whilst risky, will not lose all of your capital. So in some respects, this is just stage one of P-FIS. Take the cash out, pay tax, reinvest, get CDI share certificates, get tax back, more or less, and then watch them turn into cash. It's as simple as that. And even if you just got your cash back, having saved all that tax, there was tax saved at the beginning when the contributions were made, probably national insurance saved. So this allows the taxpayer to enjoy every penny of their previous gross income. Option E is a bit of everything, and that'll probably be what happens anyway. Like I said, this isn't a product where you put £1 million in, something happens and you save tax on it and it matures in 10 years' time. This is an ongoing strategy. You can stop it, you can start it, you can do a bit, you can do a lot, you can reinvest, or you can take the cash. It's probably going to end up being a bit of everything. And it'll be very hard, as Matt said earlier, to absolutely equate the tax paid with the tax relieved and so on. So it'll probably end up being a bit of everything. It's a strategy, it's not a product. Just going to quickly work through a worked example here. So we've assumed £100,000 drawn down from the pension scheme and invested in CDIS. CDIS is more generous than EIS. We'll cover that later. 70,000 at cost, fails entirely. This is a risk asset class. You therefore need to invest in a diversified portfolio. So maybe a handful of investments are made, those ones fail. The remaining 30,000 goes into maybe 2 or 3 investments, and they succeed, and those are the ones that drive the profit, maybe £200,000 for the purpose of this. So 100 grand in, £200,000 out, load of losses, those will drive loss relief. And we assume, just for the sake of comparability, this is not an investment illustration, that if the money's been left in the pension scheme, in ETFs, gilts, whatever, it too would have ended up being worth £200,000 over a period of, say, 5 to 10 years. The taxpayer who's going to leave the pension fund is a marginal rate taxpayer, 45% income tax. On death, will pay 40% inheritance tax, substantial estate, allowances used up. Dies over 75, so the beneficiaries are going to pay tax. And it's got unused business property relief. So the aggregate of all of this business and agricultural property is less than 2.55 million in the case of the couple. So 100% IHT exemption on unquoted shares. And let's say they've also got £80,000 of capital gains, which is taxable at 28% CGT. So they've sold their buy-to-let. They've got a bit of CGT that they want to protect as well. This is the best case. There are lots of marginal cases beneath it. The recipients, they too are going to pay marginal rate of 45%. So without P-FIS, what happens? Well, the pension fund assets on death are worth £200,000. So From today to the point of death, assets have grown from 100 to 200,000 pounds. IHT is payable at 40%, that's 80 grand gone. Of the 120,000, that eventually gets drawn down by the beneficiaries. They pay 45% tax, 54 grand. So 66,000 pounds. We did the calculations already. 33p in the pound gets left to the beneficiaries. With P-FIS, so the CDIS assets on death, they too are worth 200,000 pounds. Inheritance tax payable on them, so at the bottom, 0. The income tax paid as the original 100 grand was drawn down. Well, that is 45% marginal rate, so that's 45,000 pounds payable to HMRC. Thank you very much. Invested in CDIS, that would generate a 50,000 pound saving, and in fact, you could get the whole 50,000 if you had other income tax payable, but let's just temper that down and say for the purpose of this illustration, you just get back the tax that you paid on your pension withdrawal. So 45 out, 45 back, neutral position with the Exchequer at that point. Marginal rate of income tax relief on 70,000 of losses, the 70k that failed. This is great. This is tails we win, heads you lose as regards HMRC. It's wonderful. So the 70k you've lost, you can offset against your marginal rate of income tax at 45%. CGT, that's relievable as well. So that's lower of available gain. Sorry, I have to say, it's income tax relief on the 70k, having taken off the original tax relief. No double counting on that. Although not CGT relief, amazingly. So you lose money, you get CGT relief on it. You also get income tax relief on it. So that is double counting as far as the Exchequer is concerned in our favour as taxpayers. CGT relief, in the case of CDIS, the CGT gets forgiven, not deferred entirely. 9,600 in this case, so it's 80,000 of gain at 24%. 24%. Sorry, I said 28 earlier on. I should have said 24 because the rates have changed. 24% is a £9,600 saving because it halves the tax payable. No IHT, no income tax payable beneficiaries. So the 100 grand that came out of the pension fund and went into CDIS has grown to 200, and that 200 will generate 225,000 pounds worth of value to the taxpayer or the beneficiaries. 112p in the pound, not bad, better than 33p. So again, just to reiterate what's happened, P-FIS has freed capital from the taxpayer's pension scheme, and the liability has been offset by CDIS investing. Many options available to the taxpayer. Plenty of tax reliefs as well, other than just neutralising the original tax. But again, we've got to say P-FIS has drawbacks and risk relating not so much to the tax. It's not guaranteed that you'll get CDIS and EIS tax relief, but a good investor and good tax advisor should make sure that happens to a very high level of probability. But clearly the investment class is very risky indeed. And it shouldn't be pursued just for the tax saving. You need to make sure that the money is soundly invested. Okay, moving on to the tax foundations. Just for those who, or it's a quick recap, I think, for a lot of you. You know what CDIS and EIS investing are. They've been around since 1994 in the case of EIS and 2012 for CDIS. So they're not new. So this is not, you know, the processes, the policies are well understood by government and the investment community and the tax advisors. The schemes have been refined over the years. We're hopeful, if anything, that they might be liberalised a little bit in that the individual allowances might be increased. There's a lot of lobbying. We've been contributing to the lobbying of government. Historically, you could invest in relatively low-risk assets. That's gone out, solar farms, poultry hells, that kind of stuff. Trading businesses are in particularly technology-based businesses. So just to recap what we said at the beginning, the deal is simple. Tie up your money in risky ventures that you probably wouldn't otherwise. Get over the threshold of risk return. But in return for going over that threshold, the government undertakes not to tax your gains, will mitigate your losses and give you guaranteed tax breaks. Again, this may be best read when we share the link to the slides, but CDIS gives you 50p in the pound day one, money back on invested capital. EIS 30% day one, or at least as soon as you can get the certificates and put them in and have tax to relief. HMRC have been up and down. I've personally had tax ended up back in my account within a week. Other cases, I've had to chase repeatedly and get it back in a year. So when I say immediate, subject to HMRC. There are investor limits, £200,000 a year for CDIS investments per investor, not company. There are company side limits as well, but generally enough that it's not a problem for any of our type of investments. EIS, you can invest £1 million a year. You can carry back to the previous tax year as well. So that's up to 400 grand if you're going to take advantage of unused allowances for the previous year for CDIS. CGT relief, every pound invested halves a pound of gains, and that's permanent relief for CDIS. Similar arrangement for EIS, but it's deferral as long as your money remains invested. Much more generous, actually, carry back 3 years, carry forward 1 year, so low capacity here. Tax relief on losses at marginal rate. CGT on exit is 0 in both cases, and as we've said, 0 inheritance tax up to the limit, half of inheritance tax thereafter. Just to give an illustration, this is a non-P-FIS. This just assumes that, forget the pension scheme for the moment, you just invest £100,000. I've assumed you pay 7.5% fees to make that investment. So the blue column at the left-hand side is 100 grand, put some orange fees on top. The initial relief gives you 50 grand back. If you've got CGT payable, that would give you another 12 grand back. So that leaves you with a relatively small amount of capital tied up, about 45 grand in this illustration here. And that is your capital that's tied up for the duration, maybe 7 years until this tiny little company turns into the next NVIDIA or falls over. Even if you just get your money back of 107,000, including the fees, you've got a 2.3 times return. Even if you just get your money back, it's a 2.3 times return. If it fails, you get loss relief on the monies invested, which is another 25 grand. So your capital risk is it's a little bit less, but call it £20,000. So the loss to return ratio, even if you just get your money back, is 20p a pound at risk, sorry, 20p at risk and a pound eventually return. A lot of money to be made, even if you just get your money back. Any good investor will try and do a lot better than just getting your money back. Some struggle to do even now. EIS is less favourable than CDIS, but because a lot of the reliefs are to do with the inheritance tax saving, going back to the P-FIS illustrations, EIS will still, the £200,000, the £200,000 will still return thick end of £200,000, even though EIS is a less generous scheme. Okay, I'm coming to the end now. Just broadly about what kind of investments can you make through CDIS? It's targeted at smaller, earlier stage companies, as we've said. They've got to be risky, otherwise the government won't subsidise them. There are a lot of conditions. They're extensive and complex. We're expert in it. Matt's expert in it. Anybody who's helping you invest should be expert in it. It's not rocket science, but it does require diligence to navigate around the rules. Seed must go in before EIS. So SEIS rounds are usually very early stage. For a company that's going to raise tax-assisted monies, the seed will be the beginning. So CDIS normally taking their very first steps, university spin-outs that have just fallen out of the university, a couple of founders with a bit of industry knowledge, market opportunity, a rough and ready platform, maybe a couple of pilot customers. That's usually what we're talking about. EIS investments followed a wider span from companies that are not much far removed from what I just described to companies that have maybe got many millions of revenues but still burning cash and needing support and investment. Just a few examples from our own portfolio here. A couple of CDIS, Diabeta Labs and Ropsfit, and one EIS. So Diabeta Labs has a new and better version of Ozempic, these weight loss drugs, but without the side effects, much longer lasting. It's come out of Ulster University. We've got a bit of a franchise in Northern Ireland at the moment, which is odd considering that we're based in Manchester and Birmingham. But it's incredible science, incredible team, and this is going to be a very exciting year for Diabetes Labs. So we helped them spin out of Ulster University last year. Rockspit, very, very different. A couple of gym bunnies, amazing guys, amazing physically as well, because they're big High Rocks fans. There was no platform, no runner, no Strava for High Rocks. They designed one, and this is already now the market-leading app for these for all the other High Rocks and cross-training fans. So we made a small CDIS round last year. We just closed a 1.5 million EIS round as well. One utility bill, that was a deal we closed actually on lockdown Monday back in 2020 as we went into COVID. Quite brave, but actually inspired with hindsight. We thought it was inspired at the time, in fairness. Brilliant business. It was turning over a few £100,000 a year, and it's now doing over £1 million a month. Very profitable and looking for a stellar 2026-27. But not everything succeeds. So some downside examples. I'm not going to name names. That would be unfair. Sometimes there's luck, and you never know. You know, we're in the risk business, and sometimes founders just can't make it work. Sometimes though, they fail. Founder teams fail because they can't sell or recruit or manage, and they make all sorts of mistakes, delegate, listen to advice, whatever. Technical failure is less usual than we think. It happens more in life sciences than in other types of businesses. Sometimes they just make enough mistakes that they get overtaken and become irrelevant. Not run out of cash. That's a big risk for all of our little businesses. Regional CDIS and EIS investing, which is what we do. Yeah, there's not a huge flow of people investing, so we have to work hard to make sure the cash keeps flowing. We don't want to do it all ourselves. Sometimes companies struggle because the market is very conservative and they don't want new ideas. And there are many, many more ideas, but having quoted 3 successes, or what look like successes today, I don't want everyone to think that this is each individual investment is a surefire winner. The answer is a portfolio approach that's carefully managed and carefully curated. Do CDIS investments make money? I don't know, actually, across the industry. UK venture capital returns. Typically, investors in a fund will make 1.5 to 2.5 times their money over a period of 5 to 7 years. But there's a lot of disparity between different fund managers. You need to choose fund managers very carefully. So the best managers deliver all of the gains. The jury's out about CDIS as an asset subclass because there's very little data. Investments are made through seeders and crowdcube. They're made informally. It's very difficult to gather the data. I think my instinct is a lot of people are perhaps not doing it very professionally, as you know, it's perhaps been done out of gut feel, buying into a craft brewery that your mates, promoting or whatever. We would regard seed and EIS investments simply as venture capital. So we're aiming for venture capital returns. The investments we're making, that's what we're trying to produce. So key takeaways: choose your seed EIS and EIS manager carefully. Ask for portfolio data. That's about fees. And will they ensure that you get retained seed EIS relief? We find a lot of IFAs cautious about this because they've been burnt. They thought they were buying tax advantage products and didn't even get the tax advantage. And diversification, to repeat again, you've got to go for a portfolio, not try and cherry pick. I'm just going to introduce DSW Ventures very quickly and then pass over to Matt to talk about Claritas Tax. We're a low volume, very, very hands-on investor. We make new investments in new companies in only a handful of cases each year. We're completely engaged from day one in running our businesses, curating, in some cases, my co-founder Keith Benson at the moment is just re-engineering a business plan for a new investor. What they came with didn't work. We've worked out a way to make it work even better. So very, very hands-on, sit on the board all the way through to an exit. Got decades of operational, financial, and technical experience between us. We've currently got 17 million of assets under management. Small but perfectly formed. We invest in regional early stage businesses because there's not that much competition for them and there's excellent quality. They're very capital efficient. The quality of the management is amazing. We're an independent VC. We're founded in 2019, based in Manchester and now Birmingham, and we operate nationally under the umbrella of the DSW Group. That's us. Matt.
Thanks, David. Yeah, I think I'd probably over-introduced myself at the outset, and therefore there's not a lot to say on this one. But yeah, we're a full-service tax team. As I mentioned, that's been built up over the last decade. I'd probably say our engine room is mergers and acquisitions in terms of the buying and selling of companies and assisting the shareholders, working for private equity. We do work with a lot of venture clients, though. We do have a dedicated SEIS team that do all the sort of the compliance side of things and advising and advanced assurances. And outside of that, we have a private client team, we have a valuations team, share schemes team, transfer pricing team, employment taxes team, so on and so forth. So basically, everything under one roof in our business.
Thank you, Matt. Okay, I think we're pretty much at the end now. So in summary, P-FIS strategy, not a product. You can adopt it a lot or a little. You can try it out, see how you feel, or go wholeheartedly in if you feel happy with it. Your investments are tied up for a very, very long time indeed. Your beneficiaries may need cash, not shares, so be careful. The investments are risky. You need to go for a diversified portfolio, choose a manager wisely. There are some tax risk, dying ahead of plan, etc., but there are enough options here to be able to design something that should work for yourself. Make sure that your advisor gets you the EIS tax relief, though. No point doing this otherwise. And it just won't suit everybody, but it works much less for taxpayers with younger spouse, etc., but it might work for you. So there's enough in it, I think, for it to be worth consideration by our investors and the wider public. Okay, I think I've actually just made all of those points. So the detailed notes will contain a detailed risk warning, which you should read, but I won't talk it through now. Our contact details are in the slide deck, which you will be sent a link to. And that's us done for the day. Thank you very much. Happy to take questions from the audience. For those online, there's not a huge audience here, as you might have gathered, but and also Q&A from those on the Zoom call. Sorry, I just need to move away from my slide and see if there are any Q&A. So thank you. Go to the Zoom. Okay. So I don't think we have. I have got no Q&A here. So unless there's any questions from the audience, that's great. We have a question.
Earlier in the presentation, you talked about the sort of time requirements to hold an investment before you can claim IHT and then also SEIS relief in just 3 and 2 years.
Yeah.
Is that then a combined 5 or?
No, it's not. The 3 years is just the qualifying period to hold the investment to get the release. The 2 years was before death to ensure that you actually get the IHT relief as well on death. So they're 2 independent timescales.
Makes sense. Thank you.
Okay.
Well, in that case, we shall say goodbye. Thank you very, very much for attending, and we'll send a link through and you can enjoy this at your leisure. Thanks very much indeed. Bye-bye now.